Mohnish Pabrai's Timeless Investment Wisdom, a deep dive into value investing principles. Mohnish Pabrai, a renowned value investor and managing partner of Pabrai Investment Funds, has consistently outperformed the market by adhering to a disciplined and fundamentally sound investment philosophy. In a must-watch interview, Pabrai shared his insights on how he achieved a staggering 1,104% return, providing a masterclass in value investing principles that are as relevant today as ever. The illusion of simplicity in stock investing. Pabrai begins by highlighting a critical misconception in the world of stock investing, the perceived ease of buying and selling stocks. With the advent of technology, investors can trade thousands of companies within seconds through their smartphones, laptops, or tablets. However, this apparent simplicity masks the complexity of successful investing. Pabrai emphasizes that making informed investment decisions requires a deep understanding of the underlying business and a well-defined perspective on its intrinsic value relative to its market capitalization. Understanding market capitalization, the first crucial step. To illustrate his point, Pabrai recounts an anecdote where he asked a fellow gym member about Apple's market capitalization before advising him on whether to buy Apple stock. The individual, like many retail investors, was aware of the stock price but had no idea about the company's overall market value. This, Pabrai stresses, is a fundamental error. Just as one would inquire about the price per kilogram before purchasing rice, investors must know the total value of a company before investing in its stock. The market capitalization, which represents the price to buy the entire company, is a crucial starting point for any serious investor. Circle of competence, the bedrock of sound investing. Building on this foundation, Pabrai introduces the concept of circle of competence, a cornerstone of Warren Buffett's investment philosophy. This principle dictates that investors should only invest in businesses they thoroughly understand. Buffett himself considers approximately 95% of stocks outside his circle of competence, placing them in a metaphorical to hard pile. Pabrai argues that if even Buffett, with his vast knowledge and experience, finds most businesses beyond his comprehension, then ordinary investors should be even more discerning, likely finding 99% of companies outside their circle of competence. This isn't the case. Therefore, the first question any investor should ask is not about the price, but whether the business falls within their circle of competence. The hypothetical fortune test. Assessing investment conviction. Assuming an investor has correctly identified a company within their circle of competence, the next step is to evaluate its valuation. Pabrai proposes a simple, yet powerful thought experiment. If your family possessed a fortune 4 times the market capitalization of the company in question, would you be willing to allocate a quarter of that fortune to acquire the entire company? If the answer is yes, then buying the stock at its current market price might be justified. If the answer is no, then even a single share is too much. This hypothetical fortune test forces investors to confront their conviction in an investment decision and avoid the common trap of blindly following market trends. Indexing, a prudent option for most investors. Given the complexities of stock picking and the importance of staying within one circle of competence, Pabrai advocates indexing as a sensible approach for most investors. Index funds, such as those tracking the Nifty 50 or other broad market indices, offer a low-cost and diversified way to participate in the market's long-term growth. By investing regularly in index funds, investors can benefit from dollar-cost averaging and avoid the emotional pitfalls of trying to time the market. This set-it-and-forget-it approach aligns with the principle of long-term investing and allows individuals to build wealth steadily over time. Stop-loss orders, a misguided notion for value investors. Pabrai then addresses the popular concept of stop-loss orders, particularly prevalent in the Indian market. While often touted by technical analysts and traders, stop-loss orders, which automatically sell a stock if it falls below a certain price, are fundamentally incompatible with the principles of value investing. Pabrai finds it perplexing that even fundamental analysts sometimes recommend stop-loss orders. He explains that equity markets are inherently auction-driven, leading to significant price fluctuations that often deviate from a company's intrinsic value. These fluctuations, characterized by undershooting and overshooting, create opportunities for value investors. Using the analogy of a real estate property, Pabrai illustrates how setting a stop-loss order is akin to selling a flat at a loss simply because its market price temporarily dips, even if the underlying value remains unchanged. Value investors, Pabrai argues, buy stocks based on their long-term potential and intrinsic value, not short-term price movements. If a stock's price declines but the underlying fundamentals remain strong, it might even present a buying opportunity rather than a reason to sell. Pabrai cites his investment in Rain Industries as an example, where the stock price initially dropped after his purchase but subsequently soared, demonstrating the folly of relying on stop-loss orders. The 2-buy for test, seeking screaming buys. Pabrai's investment philosophy centers on identifying screaming buys, opportunities where the value proposition is so compelling that it metaphorically hits you over the head like a 2x4. He emphasizes that if an investment idea requires complex analysis or spreadsheets, it's an automatic rejection. The investment thesis must be simple enough to explain to a child and painfully obvious to the village idiot. Finding value in growth, a balanced approach. While Pabrai is known for his value-oriented approach, he acknowledges the importance of growth, particularly in a market like India. He agrees with the view, often expressed by investors like Ramdeo Agrawal, that finding value in growth can be a powerful strategy. A company with strong secular tailwinds, excellent management, and a long runway for growth is generally preferable to a cheap, stagnant company. Pabrai cautions, however, that even when investing in growth companies, it's crucial not to overpay. While he admires Agrawal's investment acumen, he suggests that Agrawal might occasionally be overly optimistic about growth prospects. The key, Pabrai emphasizes, is to strike a balance between value and growth, ensuring that the price paid for a growth company is justified by its future potential. The art of selling, a more complex equation. Pabrai readily admits that selling is far more challenging than buying. While buying decisions can be based on a thorough assessment of a company's current value and future prospects, selling requires making predictions about the future, which is inherently uncertain. Even company insiders often have a hazy understanding of what lies ahead. When it comes to selling compounders, companies with strong growth potential and excellent management, Pabrai suggests giving them more leeway. Instead of selling when they are fully priced or even slightly overpriced, he advises waiting until they become egregiously priced. While he leaves the precise definition of these levels to the individual investor, the principle is clear: avoid selling winners too early. Pabrai's own experience has taught him the painful lesson of premature selling. He has witnessed numerous stocks that he sold after a double or triple go on to become 100 baggers. This highlights the importance of patience and allowing successful investments to compound over time. Conclusion: enduring principles for investment success. Mohnish Pabrai's investment philosophy, rooted in the principles of value investing, offers a timeless framework for achieving long-term success in the stock market. By emphasizing the importance of understanding market capitalization, staying within one's circle of competence, avoiding the pitfalls of stop-loss orders, seeking screaming buys, balancing value and growth, and exercising patience in selling, investors can navigate the complexities of the market and build lasting wealth. Pabrai's insights serve as a valuable guide for both novice and experienced investors, reminding us that enduring principles, rather than fleeting market trends, are the true keys to investment success.